Markets had a huge up day on Friday as it looks like most of the bad news has already been priced into the market. However, the next 3 weeks are going to be a huge minefield. Can the market rally in the face of all this risk? This is your Ready Set Trade Market Minute for Sunday, the 23rd of October. Before we even get to the charts, we've got to look at these risk factors because there's no doubt that these are going to push a market around. These are going to be primary to the technicals, which are going to be secondary. So here's the coming week. We start off the week fairly light with the standard array of economic indicators and reports, but then we get into Thursday. This is going to be something that the market is going to watch very carefully. The GDP for the third quarter. So this is our first read on the third quarter GDP. If you've been keeping score, the last 2 quarters of GDP were negative. So that technically is a recession. And so they're anticipating a positive number for this GDP. That's already priced into the market right now. If that is a disappointment, that is going to affect the market. Likewise, if we see a stronger than expected number for GDP, that will also affect things positively. I think sometimes bad news is good news and good news is bad news in this type of environment. Next, we get to Friday, and Friday is the personal income and outlays. And this is one that was flying under the radar for the last few years. And all of a sudden, this is the Fed's preferred measure of consumer inflation, the PCE. So we watch this one very, very carefully on Friday. This will move the market. Between these two, GDP and PCE, Thursday and Friday, we've got our hands full. And then it gets better because this week is peak earnings for this quarter, for the third quarter. So look at this. We have on Tuesday, we have Google, Microsoft, Visa. We have Meta on Wednesday. And then we finish out the week with Apple, Amazon, Intel, US Steel, as well as McDonald's. Then we have a Friday, we have ExxonMobil, Twitter. This is a huge week. And this is, again, what we call peak earnings. When we have all these tech stocks reporting on 1 week, these are all market movers. So when we put that into the broth with those GDP and PCE numbers, we're going to get extreme volatility into the end of this week. So that's this coming week. And then the week after that, we have the Fed release. So that comes out on Wednesday, and that comes out Wednesday at 2 o'clock Eastern time. And then the chairman conference shortly after that. Again, that's a huge risk factor into the market. And then the following Tuesday, we have the midterm elections. So the next 3 weeks, we are going to be dancing around those landmines, which are going to be literally everywhere. Let's switch over to the daily chart of the S&P 500. Couple of things to note here. First of all, when markets are going higher, like this in quiet and trending behavior, which is most of 2021, what we'll see is that tops are a process before it dies, and then bottoms are an event. It tends to be very spiky before we lead up into our next rally to the upside. In this type of a bear, we have exactly the opposite of that. Bottoms are a process, tops are more of an event. And these tops have been these lower highs all the way along here, lower highs all the way along. What's going to happen here? Is this part of a bottoming process, which I do believe it is. I do believe this is a bottoming process as we've gotten close to exhaustion on the weekly chart. This is doing exactly what it needs to do. And so what we've talked about over the last week or so here is that either this is going to turn out to be very choppy and turn into a bear flag before the next release to the downside, or we might see a couple of different instances where we actually do break higher, which I think the 4,100 level would be probably the target for the top of this before one of two things happens from here. Either it drops into a lower high, lower low, and then dives into the next level of the bear. So again, 2 of these scenarios are pointed to the downside. And then the final third scenario would be we pull down to a higher low and then we rip to the upside. So I'm only giving that one the third and lowest probability of these 3 events happening from here. One of those three will happen. So in the near term, while the market's being battered by all these event risks that are coming along, that it's impossible to price in these events before they occur. We do seem to have some momentum coming with Friday. Friday was about as negative as we can be to begin with, and then it reversed. Strong move, but it's got to get above 3,800 first of all, and then the next level of resistance is 3,900, which comes in at the confluence of this descending trend line. So that is a tough nut to crack, but sometimes we can see that happen, especially if it comes on either a very negative day to start things out, similar to last Thursday, where we started out extremely negative with a hot CPI print, and then it ended up reversing on that day. So we could see something get through this trend line on a day like that, where we start out super negative and then clear out the bears to the upside. Or sometimes we can see what's called a professional gap, is where the markets decide to gap in the Asian session or the European session, and then we wake up and the futures market is already up here already, and it's just a matter of everybody chasing after it, shorts covering, and it's gone. But to me, 4,100 is probably the target for the upside of here if we do get a move up. If we do not get a move up from there, if we don't get a breakout above 3,800, 3,900, then more than likely we're staying in this range and we're just building the next bear flag. That's it for today's Market Minute. Have a great weekend. We'll see you back here in the next one.